Welcome to Pique Your Interest, your go-to podcast for all things mortgage and real estate. Hosted by Tanner Greenwald and Tim Malaskis. We bring you expert insights to help you buy, sell, and invest with confidence. Let's dive in.
Welcome back to the Pique Your Interest podcast, the podcast where we seek to demystify all things mortgage and real estate related. I'm one of your hosts. I'm Tim Malaskis. I'm a loan officer here at the Millersville branch.
And I am Tanner Greenwald with the Greenwald team here at our Millersville branch as well.
And we have what I think is going to be a pretty fun topic today. We're going to do some myth busting. So there are certain things that, when you're buying a house, your parents or, somebody that's gone through the process before might say, oh, by the way, don't do this or do this or, whatever the case might be. And so, not everything that everyone says is true. And Tanner and I put our heads together. We came up with a list of 10 things that we think we hear a lot or like questions that we get from people. And so we just want to make sure we're, doing the best that we can to educate people and busting some myths. Yeah. So without further ado, Tanner, take it away.
Well, before I start, I just thought about this. This reminds me, you've seen that commercial, it's for Progressive, where there's like a doctor or a life coach or something talking to a group of young adults, and he's trying to take away what they've learned from their parents.
Yeah, keep them from becoming their parents.
Right.
Yeah.
Those commercials crack me up. So this is kind of like that, I feel like. With that being said, so first things first, usually, I've heard people say that their parents have said, well, you need 20% down in order to buy a home. That's not true. You can put 20% down if you would like to, and it is helpful, but it's not required. There's different loan types that there's a minimum down payment. FHA is 3.5%, conventional is 3%, USDA doesn't have a down payment. Yeah. So putting 20% down is helpful to the loan situation, but you don't have to do that. So that's definitely a myth. We're going to bust that myth.
Yeah, myth busted.
Yeah. So what do you think?
I think that a long time ago, you used to have to put 20% down, right? Like that was the rule. As long as you and I have been in the business, that hasn't been the case. And so this is definitely a very old school way of thinking about things. Yeah. Obviously, putting more down is great, but you don't have to do that to qualify for a mortgage. Yeah.
I think back in the day, like I was talking to my grandma a little bit, and, she had said, like, we had to put a chunk of money down. And I'm like, oh, and then I'm also comparing it to today's age. And I'm like, thank God you don't have to, because especially with home prices as they are now, it's like putting 20% down. Oh gosh. Yeah. So
it's like $60,000 to $80,000.
It is. That's
$340,000 house.
Chunk of money.
Yeah, that's a lot of money.
If you do put 20% down, if you're going conventionally, that does allow for you to not have mortgage insurance wrapped up into your monthly payment. So that, like I said previously, there are benefits to putting 20% down, but again, you don't have to. Put minimum down if you have to. Right. In order to qualify. So.
Yeah, certainly.
What else, Tim?
I think the other big one that I hear, so I hear the 20% a lot. The other big one I hear is you have to have perfect credit to buy a house. And I am here to tell you, and Tanner is here to tell you that is not the case. In fact, a lot of people that we work with have less than perfect credit. Mm-hmm. There's a minimum credit score that lenders have for whatever program it is, whatever product it might be. There's a minimum credit score requirement. There's even exceptions to go below that if you really want to. If you have enough in your situation, you have more money to put down, you can get away with having a lower credit score or something along those lines. But you certainly do not need to have perfect credit. In fact, Tanner and I have had a couple of episodes of Pique Your Interest where we've talked about credit, or we've talked about credit rescoring or options that you have when you have less than perfect credit. So clearly that is definitely not the case. For the most part, lenders are looking for a 620, 640-ish credit score to work with you. But again, if you have money to put down, really good job stability, there could be exceptions that are made to that rule. But, you don't have to have an 800 credit score to be able to qualify to buy a house. Certainly helps, right? Just like having 20% down helps, but, putting... saying that I have to have perfect credit before I'm ready to buy a house, you definitely do not. And we work with people pretty frequently that have less than perfect credit. And that's fine.
I feel like also, if you have clients that are going through programs and stuff like that, the programs even have minimum credit scores, and they're not 800 credit scores, 700. Some specialty programs are, but even they're very understanding about credit and have, I don't want to say low credit score availability for you to use their program, but it's not like you have to be 720, you have to be 800. So people understand credit's hard to, navigate sometimes. So
yeah, it's because the other thing with credit is like once you have bad credit, it's hard to get your credit good again. Like it is a labor. And so you're not out of the home buying game permanently because you don't have great credit. So, don't think that you have to have an 800 credit score to buy a house. You certainly don't.
Yeah, no, I would agree with that.
Yeah.
Yeah.
What else? What other things do we have out there that aren't true?
Let's see. So I've heard before that you can't qualify for a mortgage if you're self-employed. Now, if you're qualifying somebody, Tim and Michelle or I on our team, if we're qualifying somebody and we're looking at self-employed documents that we would have, so tax returns, stuff like that, there are ways that clients have their tax returns and they still don't qualify. But just because you're self-employed doesn't mean you can't use that income to purchase a home.
Right.
Back in the day, they might have had stipulations about self-employed income. I wasn't on a team back then, so I don't necessarily know exactly what those were. But nowadays, we're able to pull self-employed income from your tax returns, 1099s, stuff like that, profit and loss sheets, So it is a source of income that you can use nowadays. Don't let your parents tell you you can't.
And Tanner and I have been doing this long enough that we know what to look for in tax returns. We know how to, pre-qualify people that are self-employed. It's, it might take a little bit longer because there's a little bit more documentation that's required, but it's not impossible.
Right.
And in a lot of cases, it's not even any more difficult. It's just takes a little more time. It's a little more time consuming to qualify a self-employed borrower, but it's nothing we can't do.
I will say a tip for if you're self-employed and you're looking to purchase a home, we take net income. We don't take the gross. So after deductions kind of thing. So if you're doing your taxes and you're looking to buy within the next couple of years, keep that in mind. Yeah. So sidebar.
Careful what you write off there.
Exactly. What else we got, Tim?
I hear a lot that a 30-year fixed rate is the best way to go, and sometimes that's right. Sometimes that's the right product for people, but there are other options out there. There are shorter term mortgages. The benefit, you pay your mortgage off sooner, which is great. You save a ton of money in interest over the life of the loan. Most lenders offer 10, 15, 20, 25, and 30-year fixed rates. Obviously, the lower the term, the sooner you pay your loan off, the less interest you pay. The flip side to that is you obviously have a higher monthly payment if you're going to be paying it back over less of a period of time. So, that's the trick. You have a higher payment for a shorter period of time. You save a bunch of money in interest by not paying that. There's also adjustable rate mortgages. You could have a rate that's the same for the first 5 years and then adjusts after that. If you did something like that in the mid 2000s, you made out really well because interest rates, for the most part, over the last 20 years have been declining. We've seen rates increasing since 2022, but if you got a mortgage in, say, like 2007, 2008, and it was an adjustable rate mortgage, you could have kept that thing for probably 15 years or so before you saw a mortgage payment increase year over year. So 30-year fix is not always the best way to go. It's probably the safest way to go because it gives you the lowest monthly payment, and it's guaranteed, the principal and interest is guaranteed to stay the same amount each month for that 30 years. So if you're the kind of person who operates on a budget and this is how much money I have every month to spend on a mortgage, I'm comfortable with that as opposed to the adjustable rate, which could go up or down depending on where interest rates go. Again, you made out in the the mid 2000s and 2010s. That was great. But now that we're in an environment where rates are kind of, sometimes up, sometimes down, if you're the kind of person that craves stability, then I think a 30-year fixed is good, but it's not always the best option for everybody.
Yeah. I think most of the clients that come across us, is 30-year fixed loans because they do have that stability, and that's just what our clientele kind of prefers. They favor that. So
when you're talking about monthly payments and what comprises your monthly payment, I think there's something like a myth that's there to be busted as well.
Well, I was going to say that rolls into kind of our next thing. So
that's why I did it that way.
Well, thank you, Tim. Your monthly mortgage payment is your only housing cost. Well, as Tim just explained, there are factors that can change the monthly payment. Now, if you are a 30-year fixed rate situation, then your principal and interest, they stay the same throughout the life of the loan. unless you're in an ARM or something like that. Couple of things that could change as a part of the monthly payment. So if you're purchasing into a townhome or a condo unit facility or whatever, there's condo fees, there's HOA fees, and they do fluctuate. They do go up. I live in a townhouse, and my HOA goes up religiously every year. Not by much, but it does. So that fluctuates, your monthly payment. Property taxes. I mean, I think a lot of people are seeing this right now. If you already own a home, property taxes can, and they more than likely will go up at some point. So, what we pre-approve you at and what you buy the home at, and that's, let's say your property taxes are $320 a month as a part of your monthly payment. Okay, well, in 5 years, if your property taxes go up, maybe it's not that anymore. Maybe it's $450 and included in your monthly payment. So, your principal and interest, that's not just what your monthly payment is. We try to be helpful when we're running numbers, and we include your HOA if you have one. We include your condo fee if you have one, to give you an idea of what that monthly payment's going to look like. But we always tell people, Michelle and I'm sure you do too. Like, this is probably going to change at some point in the next coming years because of property taxes, because of insurance. We can throw insurance in there. If you call your insurance agent and say, hey, I want to add a couple things to, my policy, that could make it go up. Or if you take some things away, it could make it go down. So, don't just think that when you purchase a home, the monthly payment shown on paper is exactly what it's going to be for the life of your loan, because that's more than likely not true.
Right.
Yeah.
And especially if you're the kind of person that budgets and you're thinking, okay, I can afford this. Be cognizant that in future years, year 3, 4, 5, 6 down the road, you're going to have, your property taxes are going to be reassessed at some point. Homeowners insurance inevitably goes up, even if you don't file a claim. Just the nature of things, it gets more expensive.
Yeah.
Tanner's HOA goes up. That is the reality of life. And so it's not just, my monthly payment now, it's my monthly payment now plus a couple of dollars more each year. Just, as you're thinking about life, just make sure you're comfortable with what that payment's going to be over time.
And speaking of monthly payment, Tim, do you have something to say about mortgage insurance? Because that's also part of a monthly payment as well.
I do. So, for the longest time, mortgage insurance was seen as, sort of a 4-letter word in our industry. And there really is no benefit to mortgage insurance to a buyer at all.
Yeah.
It's to protect the lender in case you default on the loan. And most people don't. So most of the time, mortgage insurance never really comes into play. But mortgage insurance is not always bad just because there isn't a benefit for you. And so for instance, Tanner had mentioned earlier, if you put 20% down, you avoid mortgage insurance. That's great. You don't have that as part of your monthly payment. But you can get away with putting less money down, say on a conventional loan, 5 or 10% down. Instead of putting 20% down, let's say you put down 10, you just saved yourself 10%. Yeah, you're going to be paying a little bit for mortgage insurance, but if you're the kind of person that likes to have money in the bank, save for a rainy day, maybe having mortgage insurance isn't the end of the world. And, there's more than one way to handle mortgage insurance. Yeah. Most people are familiar with mortgage insurance being, a monthly part of a monthly payment, kind of like FHA loans require that you have a monthly mortgage insurance for the duration of the loan in most cases. And so when people hear mortgage insurance, they think that's part of your monthly payment. It's always going to be part of your monthly payment. There are actually conventional options where you don't have to do that. You can pay for it up front, outright in cash at closing. Yeah. Have it added to your closing costs. And instead of you paying it monthly, you've paid it outright. It takes people like Tanner and I, figuring these things out for you, saying, here's an option where you pay it monthly. Here's an option where you pay it, up front. And here's what the difference is. Here's where your break-even period is. So it's, it doesn't benefit homeowners to have mortgage insurance, but there are certainly cases where having mortgage insurance can make sense, or paying the mortgage insurance up front at closing instead of bringing all 20% to closing. Yeah. Maybe you have a 5 or 10% down payment, making it a little bit more achievable. Because again, 20% down on a $400,000 house is $80,000, and that's just the down payment. That's not the closing costs. So if you're not working with 20% down, it's not the end of the world, and you actually can get a really competitive loan. And honestly, mortgage insurance has become cheaper over the last few years. If you looked at it, I don't know, probably 10 years ago or maybe even more, it was pretty expensive. If you're going to buy out your mortgage insurance, or you're going to pay it monthly for 15 years or whatever the case was, it added up to be a pretty astronomical number. It's a lot more affordable now. And so I think that's partly because it's so expensive to save 20%. You don't see a lot of people doing it, and because less people are doing it, it's a more affordable option. So I would never say that all mortgage insurance is bad. There's certainly a time and a place for it. And again, most people don't have the 20%, so you're going to have some kind of mortgage insurance in a situation like that.
On some loan types.
On some loan types, correct. So that's the podcast today. Hope you found it enlightening. Hope we busted a couple of myths and helped you realize that, some of the things that you might have been, the myths you've been operating under are not exactly true. I'd be curious to see if people have other myths that they want us to bust.
Comment if you've ever heard anything from parents or just older generation people that you're like, really, is that true? We want to hear too. That'd be interesting.
Yeah. I'd love to do a part 2 of this sometime where we have extra myths to bust. So give us some material. That way we can come back at you another time and bust those myths. Anyway, hope you had a good time. Hope you learned something, and we'll talk to you soon.
All right. Have a good day.
Bye.
Bye.